Facebook hooked up, and that's happened. So now we can actually get underway with the webinar. Hello everybody, and welcome to today's special event in which we will be exploring the likely impacts on residential real estate from the virus crisis. I'm Terry Ryder, founder and managing director of Ryder Research Resources, the publisher of the Hotspotting website, and my special guest today is award-winning buyer's agent Rich Harvey, who is the founder and CEO of Property Buyer. Now, in terms of the general interest in this webinar and the number of registrants, this is by far the biggest webinar we've ever hosted at Hotspotting, and this is not so surprising given that our media is totally dominated by the coronavirus coverage, with situations and their impacts on our lives changing daily and in some cases hourly. There have been acres of space in various forms of news media being devoted already to the emerging impacts on property markets, and there have been some alarmist predictions, which we do tend to see in times of crisis, but by and large, most of the forecasts for our property markets have been quite calm and moderate in nature, with most commentators suggesting that the housing market is likely to be a more resilient animal than most sections of the national economy. But we're going to explore these issues in depth over the next hour. We've got record numbers of people tuned in live today, and we're expecting lots of questions, and we do encourage you to send through your questions or your comments by typing into the chat box, which you should see on the screen in front of you. So let's get into it. Rich Harvey, CEO of Property Buyer, special guest presenter today. Welcome.
Great to be on the webinar live with you today, Terry, and we're looking forward to sharing lots of great information with all of our viewers out there. So today, I guess, Terry, we've got a couple of objectives. One, we just love to give you some information on where we see the market going ahead in the next couple of months. And we really want to give you some independent information so you can make some accurate decisions on where you need to go. We also want to really give you some hope and confidence in the resilience in the property market, but even more than that, we really want to help you prepare. And I think it's really important that you take steps now to prepare to protect your family, to protect yourself, and to get yourself in a position where you're going to be able to weather the storm that we're having at the moment. So I'm going to share some slides that we're going to share with you today. So we'll just put them up on the screen. So as I said, today we're going to be talking about the coronavirus and whether that's a threat or an opportunity, or potentially both for the housing market. So let's get into it, Terry, before we go. So as we know, with any crisis or economic shock hits, we certainly weren't expecting this one to come. I remember starting the year thinking, wow, the market's rebounded with a bang, and we weren't expecting to see such a sudden economic impact. But for every economic impact, you know, it will pass. It's like a storm, and we're very much heading toward the eye of the storm at this point at the moment. So, you know, I think it's important to look at this virus in context. And this is an interesting visual chart being done by a group called Visual Capitalists, just to look at the number of deaths and infections with other types of shocks that are hit. Now, I'm no medical doctor, so I'm not going to spend a lot of time on this, but obviously it's tragic for those people that have been impacted by the death of loved ones with this virus. But when we look at it in context, we see it's still a relatively small compared to previous plagues that we've had in the past. And look, it's certainly a tough time, and I just encourage everyone to follow the health warnings that are out there by the government. And we need to, you know, adopt that adage of think global but act local. You know, we need to make sure we protect our loved ones, and it's still early days in the cycle. So, but Terry, I'd like to ask you perhaps the next question. What do you see at the moment as the fallout coming from this virus, and what have you been seeing out there as the shocks that are filtering through the economy?
Well, the economic shocks are obviously considerable, and they're particularly so on businesses that operate in the tourism space or the hospitality space. There will be others as well. We probably all saw the images from the news last night on the queues that have formed very quickly outside Centrelink offices in our major cities as a consequence of the immediate impact of that. I do think that the stimulus packages that we're seeing are going to make a substantial difference. It's going to help businesses to stay afloat, those that are most directly impacted, and to keep their people employed. And it's important to remember that the big one that was announced on Sunday will not be the last. I think the political leadership's been at great pains to make that point. There will be other packages to come as the needs appear to be to evolve as we go forward. But there are also stimulus packages coming from all of the state and territory governments, and we're also seeing stimulus packages or special moves in response to the crisis coming from some of our major city councils. Brisbane City Council, for example, has announced a range of infrastructure projects that it wants to fast track that were in the pipeline, pretty much shovel ready, many of them, and they're bringing them forward and seeking perhaps federal government assistance to do that. So we're seeing a range of stimulus measures. We're seeing the major banks, the lending industry also coming to the party because they have a vested interest in keeping both businesses and their mortgage borrowers afloat. So there's going to be assistance evolving out of the major lenders in that regard as well. So all of those things are going to have the effect of cushioning the blow. The other thing I think that needs to be kept in mind, and it's very hard given the nature of our media and the tendency towards sensationalism in some parts of media, to keep in mind that it's likely to be quite short term in terms of the longevity of the event, and we hope that we can get back to some sort of normality in a matter of few months.
So I think, Terry, my take on this, the multiplier effect, is putting my old economist hat on, that there's no doubt that disruption is going to be severe. It's affecting everybody. We've all known someone who's suffered job losses. I mean, even my executive assistant, Michelle, her husband lost her job yesterday as a senior chef. And so we know that it's affecting everybody. And the speed of this fall has really impacted everyone quite unawares. So I think we're going to see unemployment at least hit over 6%, if not up to 7%. So that's going to have a dramatic effect. The share market's already plunged, but construction is still going on. There's things that are still happening. There's still activity. Not everything is ground to a halt. So the thing that's susceptible in the economy is the high level of household debt and the level of incomes that people had. But the thing to take away is that generally the property market has performed well during these economic shocks and been quite resilient. So if we think back to the GFC time, the share market plunged 55% in 2008, but the property market fell only 7.6% during that same time period. So it's interesting to see just how different markets react to economic shocks. Terry, I'd love to just move on to our next slide and just talk about the impact on auction clearance rates. And what we've seen here is that last weekend, auction rates dipped. In Sydney, it was down to almost 64%, Melbourne 64%. But when we look at the week before, on the next slide, you'll see that at the beginning of the year, they were up at 85% and 81% respectively. So obviously, we've had a very dramatic turnaround in auction clearance rates at the moment. But the thing to take away from it, it's not one property market that's impacted. If you look at the auction clearance rates right across different sectors of Sydney, for example, you can see that the inner west and lower north had 81% clearance rate. There was a bit of almost panic buying for some people going, gosh, I better get in before the market, there's no properties to buy. Whereas other parts of Sydney, Central Coast, Bankstown, was 45% and 55% respectively. So interesting to note how auction clearance rate. So that's a number that we'll be closely tracking.
Now, some of the points that have come out, because we've been tracking those as well, Rich, and in some sections of the Brisbane and Melbourne markets, comparing last weekend with the previous weekend, the clearance rates actually rose, although probably as an average across the cities, there was a decline, but still well ahead of the clearance rates that we were seeing 12 months ago. Figures just came through today from SQM Research, which is a great source of all sorts of information about Louis Christopher's business. And the average rates for New South Wales last weekend was 71%, for Victoria 67%, for the ACT Canberra 74%, and South Australia, primarily Adelaide, 65%. So those are pretty healthy auction clearance rates in the circumstances. That's right. And not significantly down on the previous week and well up on where we were 12 months ago. Right. The other point I think needs to be made is that even in our biggest cities, the vast majority of real estate is not transacted by auction. It's transacted by private treaty. We're probably going to see an increase in the number of sales happening by private treaty simply because of the restrictions on gatherings. It's going to force real estate agents to operate a little bit differently. We're actually seeing that. We're actually seeing the more switched on selling agents introducing virtual tours, that kind of thing. That sort of thing's already in the market, but there's been a ramping up of that to take into account the fact that gatherings of people and the risks associated with that has to be taken into account in the way people handle real estate transactions.
Yeah,
so
exactly.
I think real estate is going to continue. It's going to continue to be busy. Just the way that it happens is going to be a little bit less auction orientated as we go forward, I think.
So just talking about SQM research, here's the latest numbers on weekly asking prices, which SQM tracked very closely since 2010. You can see basically tracking up and then some volatility over the last couple of years. But if we look at particularly the change from last week to this week, and if you look at this figure here, 5.6% down. That's quite a dramatic drop in sentiment. And that's a theme that I just want to talk about now with you, Terry, is about the fundamental changes in the market. And the question on everyone's lip is this one: will coronavirus fundamentally change the property market? So my take on this is that the property market is in some ways sentiment driven, but it's also fundamentally driven by population growth, by the state of the economy, including employment levels and infrastructure growth. But I believe it's going to change the way in which we interact with each other, as you talked about. But I don't believe it's going to fundamentally change the property market. I think this crisis will be short-lived. We will get through it. I can't say exactly how long it will take, but we've got a demand-heavy property market. If we think back to the beginning of 2019. We were facing a very sort of dour market. We had a state election in New South Wales and a federal election in May. Everyone thought negative gearing was going to be introduced, and there was just very few transactions happening. And then there was a change of government, and sentiment just changed almost overnight again. So what I believe is that there's strong demand sitting under the surface there, and tight restrictions on development and on planning are going to continue to create a supply shortage. So we've got, as I say, population growth, migration coming in, aspirational buyers wanting to improve their life. So I believe that we won't see a fundamental change in the property market. We're just going to see a very severe short-term downturn and then a sharp rebound. What's your view on sentiment impacts in the market, Terry?
Yeah, I think in simple terms, we're likely to see a reduction in activity, but not significant reductions in prices. Prices, the price levels is how the media tends to chart markets. We look at other things as well, but in terms of pricing, I don't expect there to be a significant decline. But I think activity will reduce. But one of the things that's happening and will happen, I think vendors are already not listing their properties for sale at the same levels they were a year ago and 2 years ago. And I think that's going to be exacerbated by the virus crisis. We already have a situation of shortage, which you've alluded to, and that's reflected in a number of the statistics, including vacancy rates, the number of properties listed for sale. The building approval figures last year were significantly down on the previous year. So we already have a shortage situation at a time of quite strong demand, and I think that shortage in terms of listings in particular is going to be exacerbated by the virus situation. So we're still going to have demand, but we're going to have relatively few properties for sale, and I think that's going to help to put a floor under values. I think we're still actually going to see some value rise. We'll also have to be very careful to not talk about Australia as a single market. There's lots of different situations, lots of different markets across Australia, and different places will be affected in different ways. I think regional Australia, as a generalisation, is going to be relatively insulated from this. I think regional markets, all the evidence we've seen so far, are still pumping as normal, and particularly those that aren't hugely reliant on the tourism industry are going to still be quite healthy. A very important point to keep in mind when considering all this is that markets at the moment are fundamentally driven by owner-occupier buyers. Going back to the previous boom in Sydney and Melbourne, investors were very prominent and foreign investors were prominent. Well, foreign investors have previously been taken out of the equation. By and large, they're not nearly as prominent as they were, and investor buyers in Australia are also much less prevalent. It's very much an owner-occupier market, first-home buyers as well, and I think that's part of the strength of the property market, generally speaking, going into this crisis, that it's not investor-driven, because that's probably where the drop-off is most likely to happen first up. There will be some impact from people who temporarily at least lose their jobs, so that may impact some first-home buyers. But I think fundamentally the market is very strong going into this situation, and I think it's going to hang tough pretty well.
So let's have a look at some just on the resilience of the property market, Terry, from a few charts. This is one from CoreLogic that's just recently been released, again showing property prices and over a period of time, the percentage increase per annum over a period of time. If you look at from 1985 right through to the present day value, you can see the number of times we've been below the line is 1, 2, slightly there, 3, 4, 5, 6 times. But look at the gains over time. It's always rebounded within a relatively short period of time. So, you've had the black market stock crash, Monday stock crash, early 90s recession, Asian financial crisis, dot-com bubble burst, GFC, China steel glut, so all of those issues. And yet our market has remained very strong, and particularly the last 7 years, we've had a very, very strong market. I've got a similar chart here from Morgan Stanley, again, showing the same kind of effects. And you look at, again, what was the trigger for prices going down? It might have been, obviously, negative gearing is removed back in 85. That had a dramatic impact. We've had a couple of other economic shocks during that time. Also look at when demand has spiked, particularly for the first home buyers, where we see that demand really increased up around these parts here. But again, the general trend and the general theme, it shows that property is a much more illiquid asset, and it has much less volatility to the share market. And when you have declines, sure, you do have some declines, but they are a lot smaller, and because people don't wish to sell their home at a loss. So again, if you look at it compared to the share market over time and compare property price growth with the ASX 200 price index, you can see how strongly and less volatile the property market has been. So again, it just goes to show that both home buyers and investors that stay the course, that don't panic sell, they're the ones that will tend to do a lot better over time.
Yeah, Rich, there's no direct comparison to our current circumstances, but the one that most closely parallels it in terms of economic circumstances is the GFC, which struck in 2008 and caused the federal government of Australia to introduce stimulus packages and the Reserve Bank to take emergency action. And at that time, there were quite a number of doomsday forecasts for property values. There were some forecasts that values in Australian real estate would fall 40 or 50%. But what actually happened in 2009, when that was supposed to be happening, was that as an average across the capital cities, according to the Bureau of Statistics figures, property values in Australia rose 13.6% in 2009, and then a further 6% in 2010. So amidst all that volatility with share market crashes, stimulus packages, etc., and predictions of double-digit unemployment and property crashes, real estate actually rose strongly amidst all that mayhem. And it's not totally the same situation this time. This one's unique in many ways, but we have seen examples such as back in the time of the GFC, where real estate is that beacon of solidity and safety that investors and others like to retreat to in times of crisis. So I think we're going to see potentially similar outcomes this time.
Yeah, I agree. So Terry, the question I posed here is the stimulus package enough? And I'm sure everyone watching is going, no, it's not enough. We need more. It needs to hit our hip pocket first, and we need to survive the crisis to get money into our pocket. But I can tell you what I can see, the government's spending like crazy. Doing a Keynesian approach to a downturn, which is spend our way out of a problem. But we need to have that. We absolutely need people to stay in their jobs and have income flowing and the wheels of the economy turning over. So we saw last night the government announced a further $66 billion injection on top of the $17.6 billion. So there's $83 billion coming into the economy, still yet to flow into our individual pockets. But basically, I don't think any kind of stimulus is enough to ward off a potential recession. I think we may hit a recessionary period. But once we see off the health crisis, I think we'll see a recovery happen pretty quickly. And even if we do have a recession, it's not the end of the world. People think recession is just absolute, everything's gonna crash. But it just means that we have a period of time where we're going backward for a time, and then we've got a period where we need to regroup and move forward and come out the other side. In the early 1990s, Australia experienced a recession and properties declined in value about 4.4% between June 89 and October 1990. And then when we had the GFC, as you talked about, national property prices declined 7.5% between February 2008 and 2009. But then as soon as the Reserve Bank started cutting rates and the stimulus saw a swift recovery. So I think that's what's going to happen here. We're going to get through this crisis. It's going to be really hard for a lot of people, especially those that have lost jobs. We're all going to have to pull together. But I do believe we're going to have a period where we come out, we're going to have ultra low interest rates, and we're going to see that demand bubble up to the surface yet again. What do you think?
I think in times of a crisis like this, or any crisis, there's a tendency for people to see the current situation as pretty much this is the reality for the foreseeable future. But I think this is going to be relatively short term. The countries that were affected first, including China, South Korea, Singapore, etc., and took pretty tough action ahead of what Australia has done, are now starting to see a flattening of their curve. And what we're hearing in China is that they're starting to relax some of the restrictions that were placed on the population there. That's been in a relatively short time of 2 or 3 months. So I don't think people should be lulled into thinking this is going to be a 6 or 12 month scenario. I think it's going to be shorter than that.
Yeah.
We can't be certain of that, but I think it's going to be relatively short term, and that we will get back to some sort of normality quite quickly.
That's right. Well, I think as we talked about sentiment before, this is the classic survey that's done by Westpac and the Melbourne Institute, tracking how consumers feel about spending and all the economy in the moment. And you can see that we're actually hit a period of downturn here. So it's declined 3.8% in March to a 5-year low, but we're still at 15% higher at which we were during the bottom of the GFC. So that suggests that consumers actually are slightly less worried now than they were during the GFC. But again, I think it will rebound fairly quickly. But I think the sectors that you already alluded to, Terry, the sectors in the economy that will be worst affected is particularly the hospitality and tourism industry, also contract workers. I really feel for those people that have got cafes and restaurants and bars and whatever, or entertainers. They're particularly just immediately their business is gone for a period of time. But I do think that people will adapt and find new ways of working, like we're all adapting to working from home and working remotely. We might even see tradies wearing gloves, and we're having more online meetings like this webinar where we can communicate with a large group of people and effectively. But any other thoughts, Terry, on what sectors you think will be badly affected?
Look, I think we're already being well acquainted through the media with the sections that will be negatively affected. Tourism and hospitality is the big one. There will be others. What we're not hearing about is the industries that are unaffected relatively, or indeed the ones that are actually booming. There are actually industries out there that are actually thriving, going through unprecedented booms as a result of the situation. Technology companies, for example, this webinar is going out today through the medium of Zoom. Zoom is having a boom like they never have before because of the circumstances. Companies are having board meetings via Zoom. I'm having all of my meetings via this medium. There are other alternatives like Skype, for example. That's an example of an industry. I mean, supermarkets are obviously thriving. Everybody who supplies supermarkets is thriving, but businesses like Anthony Pratt, he's one of the richest people in the country. He's got the cardboard box business. That is absolutely unable to keep up with demand for cardboard boxes. There are lots of other, I noticed a story yesterday that BHP has just announced it's hiring an extra 1,500 workers. The resources sector is continuing on pretty strongly. Telstra, which was had previously announced it was cutting employees before this crisis struck, has actually announced that it's actually freezing the job cuts programs and actually rehiring people in several and by the thousands in response to the current situation. Food delivery businesses, there's actually quite a lot of businesses that are actually going to be thriving through the circumstances that we're currently faced with, and others that will just continue, particularly big infrastructure projects and resources projects. There's a number that have made announcements just in the last week. Sydney Metro, they're digging a tunnel underneath Sydney Harbour. Just had a major breakthrough. Those sorts of big infrastructure projects continuing on pretty much as normal. We're less likely to be hearing about that in this circumstances from media than we are about the ones that are suffering. And I don't dismiss the impact. We saw the queues outside of Centrelink in the news last night. So very much aware of those adversely impacted. But I think people should also keep in mind that there are industries that will be doing well and actually hiring people.
That's be a lot doing it tough out there. So our thoughts and thoughts go out to them. I guess, Terry, this is the question on everybody's lips: is how long will this property downturn last? And I couldn't help but think back to you actually alluded to this story a little while ago in the presentation about where 60 Minutes did that irresponsible journalistic program and interviewed only selected people. But yeah, my thoughts on how long the property downturn will last. I actually asked Louis Christopher before I came on the webinar, and he actually sees this current situation as a bit like a very large storm. He says, look, we're currently approaching the eye of the storm, and we're going to see daily news about uptick in new virus infections, and then the storm's going to start to dissipate. And that's going to depend on how quickly we get containment measures and the socialisation measures in place. And if we don't isolate, then we're going to get harsher measures. And we're also going to see job cuts, but we also know that it takes not very much time to cut a job, but it takes longer to create jobs. So I think we're going to see a sharp downturn, there's no question, but it could be a short, sharp downturn. Prime Minister Scott Morrison is saying that, prepare for 6 months, but I personally don't believe it will be that long. I think it'll be about 4 to 6 weeks before we start to see a real containment in place. And then I think we're going to start to see green shoots, and we'll come to what we talk about that a bit later in the presentation, Terry, very, very soon. But
yeah, I think the Prime Minister is preparing us for the worst, but hoping for the best. Right. I think, when he's saying 6 months, I think he's very much hoping and expecting that it will be shorter than that, and what will be delivered will be a lot more positive than that forecast. It's interesting you've got that image on the screen. Those kind of forecasts that 60 Minutes. They actually called me when they were preparing that story.
They did to me too, and they didn't interview me either. I agree. Yeah.
But as soon as they found out that I didn't agree with their forecast, they hung up and were no longer interested in talking to me. They had a preconceived headline in mind, and they were totally wrong. Of course, that forecast didn't come to pass. I've actually got on my wall in my office here a list which is the top 20 worst predictions about real estate. Those kinds of predictions about real estate have been happening constantly over the last 10 or 12 years, particularly since the GFC, but they've been rolling out. We've had certain doomsday forecasters like Harry is dead. Every time he comes to Australia, he predicts a crash in your property.
All he wants to do is sell his book, Terry. That's where he gets media.
Or to get free publicity, get bums on seats at a webinar or seminar, and media gives them free publicity every time, but they've all been wrong with those predictions. And I think real estate is going to defy the doomsday forecasters again this time, although I think there will be more of an impact than we have seen in the past, but it's going to be, as you say, Rich, I think it's going to be short and sharp.
Yeah. So I want to get through, we've got the next few slides because I know everyone's busting to ask their questions, but just quickly, lending. Will APRA loosen the reins a bit more? Well, they've already started to, which is great news. I don't think there's any chance we're going to see APRA tighten in this market. I think they're going to start to loosen the reins, and they've already given the banks permission to tap into their capital buffers or their capital ratios. So that's going to allow a lot more lending, particularly to small business, where businesses get up to $250,000 on an unsecured loan, and it's underwritten by the banks. So that's very good news there. But Terry, I just want to move on more briefly to how should sellers approach the current market, and then we'll move on to how do buyers approach the current market. So firstly, my view on how sellers should approach the market. If you're selling a property, I'd firstly say don't panic. Remember that if you're selling, you're typically buying as well, and you might be trading in the same market. You're going to need a proactive agent because there are going to be different ways to get people through the door. Usually it's going to be by appointment only now instead of in group open inspection homes. And it might be also a good idea to consider getting your agent to try and sell it off market through a pre-market campaign. So we buy a lot of properties for our clients off market because of our relationships with agents. And typically the agent can work one-on-one with individual buyers. But I do think vendors are going to have to meet the market. They're going to have to realise that they're not going to get a record price in a market that is declining slightly. But one of the other big issues is also there's going to be a lack of stock. So as much as we are possibly going to see price declines, it's also going to be counterbalanced by the lack of stock on the market. So that's where I see it, Terry. Any other thoughts on that, Terry?
Yeah, I mean, we're already starting to see different behaviours from sellers and buyers. I mean, you would know this pretty well, but you mentioned off-market. I think we're going to be seeing more of that, and we've been seeing that in recent weeks, according to what I'm reading and hearing, that people are trying to panic buying of real estate has become a factor, apparently, and you can perhaps comment on this better than I can, but I've certainly been hearing about it, that people are trying to preempt auctions by getting in and buying before it actually goes to auction. But we're certainly going to be seeing a lot more real estate transacted in methods other than auctions, simply for practical reasons, the risks of gatherings. Home opens are going to have to be conducted in different ways. We're going to be seeing more virtual tours, and but you know, people will innovate. We're already starting to see that happening to keep their businesses going and to keep transactions happening.
That's right. Well, I guess the next question, Terry, is how should buyers approach the market? And that's what my business is obviously all about. But my advice to buyers is still to be cautious in this market. You've got to make sure if you are buying a property that you're fully finance approved, pre-approved before you make any offers, and make sure your source of income is going to be secure. Last thing you want to do is get yourself into hot water where you've got to sell a property under distress. I'd also, think about the long term. Long term, we're going to see this market, and short term, we're going to see prices decline, and then we're going to see prices increase back again. And the best time to buy, in my view, is when we see what I call peak panic. The classic Warren Buffett scenario. Be fearful when others are greedy, greedy when others are fearful. It's a bit of an overused cliche, so I haven't put it up on the slide, but I think when sentiment is at its lowest, and we won't know exactly when that point in the cycle will be, but that's probably, from a buyer's perspective, one of the things to think about. But I'm not saying you should wait for that particular point. It's pretty much a mug's game to say, I'm going to buy on the weekend when I know sentiment is the lowest. If you're buying for the long term, and you find the property you like and that ticks all your boxes, do an evaluation, do an appraisal, and buy it. You're not going to make sure you don't overpay, obviously. The other thing I'd strongly recommend is consider using a buyer's agent like ourselves. We can go and do the open homes, and you can avoid mixing with the crowds. We can do all the tours for you and show you the properties, and then help you make a decision very wisely on what you should be paying for it. But Terry, any other thoughts on how you think buyers should approach the market?
Look, I think buyers should be thinking in terms of opportunity, and there will be opportunities, but buyers, I think, should also be very much aware that we don't have a single market. I think this is a point that needs to be made again and again. A lot of the most of our media comes out of Sydney and Melbourne, and that perspective has been put 99% of the time. There are many other markets in Australia where different scenarios are playing out. I think for buyers, there are going to be good, strong growth opportunities in regional markets in some of our smaller cities that will be less dramatically affected. And I think some regional markets in particular, I think, will be relatively unaffected. And, obviously much more affordable buying in those places, better rental yields, and if you buy in the right places, good opportunities for growth. So a buyer should be thinking opportunity. I think too many will perhaps fold their arms and say, I'm just going to wait and see this is all over because there's too much uncertainty.
Yeah.
But I think the Warren Buffett approach is a good analogy. It's a time to be looking for opportunity when others are perhaps intimidated by the circumstances into sitting on the fence.
I think it's one of those rare points in the cycle, Terry, where the market's taken a really dramatic pause and going to go back slightly, and then it's going to resume its trend upwards. So none of the experts were expecting a virus. It's an external shock. So I definitely think you're right about that.
Yeah.
I just mentioned, we should have put this in earlier, but we talked about dwelling approvals falling, and you can see here that dwelling approvals overall have been trending downward over the last 6 years. And I think that's just going to sort of underwrite pricing in the future. If we're not building enough houses, if we're not, we need to really build around 230 dwellings a year in Australia. And at the moment we're heading, you can see there since the peak of the market back in November 2017, we're really dropped down to about 150,000. So we're almost like 80,000 dwellings short per annum. And that's going to build up a head of steam, just like it did when the market started to rise in 2012. So that's just something to consider longer term. I just want to mention, Terry, for all our viewers today, if you are interested, it's obviously a shameless plug, but if we are interested to use our services, we want to provide a special offer just to our viewers today, only those that are on the call. If you send us a note or an email or log onto our website and send us your brief, Pete Domigen, our Director of Client Strategy, would love to have a chat with you. And we're offering a 10% discount off our engagement fee. And I put a code word in there, which you have to mention. It's COVID 2020, so we know the year. But if you mention that, we'd love to work with you and help you achieve your property goals and really just find out where you're at and how we can help you move forward. Rather than panicking or worried about your future, we'd love you to help you move forward with your buying plans. And just to mention the steps that we take to help our buyers, Terry, is really these 7 steps. I won't go through in detail, but we basically take people through the whole buying journey, from creating their brief, providing the research, evaluating the property, negotiating and securing the best possible home or investment for our clients. And we've got obviously been very successful in that. The last 20 years we've been in business and won lots of awards for doing that. So Terry, just as we move on, I thought I'd just make this other quote by Benjamin Graham. It's always buy straw hats in the winter. I love that one. It's, it's an analogy similar to the Warren Buffett idea, is that, don't follow the herd. When everyone's going the other way, perhaps, it's a time to look at buying a very strong asset when the market gives you that opportunity and takes a pause. So that's just a philosophy that I certainly adopt in the way that I like to invest going forward.
And I think it's important for people to just keep in mind that real estate is a long-term play, and the circumstances we're in are a short-term crisis. And it's interesting to me that amongst the many forecasters out there, last week the chief economist for National Australia Bank, Alan Oster, announced that they are fundamentally not changing their price forecast for this year for the major cities, because they are their forecast for the full year. And they believe that this short, sharp downturn will, after which we will get back to normality relatively quickly. And so not changing the forecast.
Interesting. That's a really interesting point. So Terry, where do you see, are there any sort of opportunities? You've used that word. Are there any particular markets or price points that you think might be an opportunity for the home buyers or investors out there?
Yeah, and it's interesting, some of the questions we come through. There's a question here from Rusty, what would be the hot spots for someone who's cash rich? Yeah, I mean, there will be, as I said, opportunities, and I think there's going to be plenty of good opportunities in our regional markets, which too many property investors overlook in normal times, tend to be too focused on the biggest cities. I think regional Australia, the strongest markets over the last 2 or 3 years in Australia have actually been regional Tasmania, regional Victoria in particular. And we're just going through the quarterly figures on sales activity and prices as we do every quarter. Regional New South Wales has actually come very strong in the recent period. more than it was 6 months ago, certainly, and 12 months ago. There's lots of really good, strong regional cities out there. Places like Orange, Wagga Wagga. I noticed that Wollongong is a market that had been in a bit of a low is coming out strong. I noticed that there's a big revival and activity in the Central Coast, which had been in a bit of a post-boom downturn. So we're actually coming into this crisis period. There are markets out there that are really were starting to pump strongly, and I think many of them will be relatively unaffected by these circumstances. And I think for buyers, it's a question of thinking about where those places are most likely to be found, and then doing some research, and as you suggested earlier, engaging professionals like a buyer's agent, like property buyer, to actually find those opportunities for you, because there will be great opportunities to be found.
I think, Terry, just anecdotally, I bought a property on the weekend for a client. We exchanged at 7 o'clock on Saturday night, and it was a home buyer in the Northern Beaches area, and we paid $2.2 million for a 5-bedroom home, 3-bath, 2-car. And originally it was out of my client's price point because they were quoting 2.3 to 2.4, and had it gone to auction several weeks ago, it would have gone for a lot more. Actually, the owner had actually received an offer of 2.3 just 3 weeks prior, but they knocked it back. So it's interesting to see how negotiable some vendors will be when the market has turned. So look, there's opportunities in the prestige market, there's opportunities in the mid-level market of the property market, and also at the lower end. So I think there's going to be opportunities across all price points and across the markets. And I think, as you say, don't just think about cities, but also the regional areas. I want to talk now, Terry, about turnaround and I guess the signals that the market is turning around. As I said, I think in my view, the moment we reach the peak cases of the coronavirus, and we start to see messages of improvement and start to see things settling down, that's the moment I think that sentiment will change. I think we'll start to see auction rates stop falling, and they'll stabilise and then begin to rise. I think we'll start to see the volume of transactions in the property market also start to rise, which is always a leading indicator, as your price predictor report points out. And I think we'll start to see some stabilisation and recovery in median prices in areas that have fallen quickly. So are there any other signs that you would look for, Terry, of a turnaround?
Look, I think the best signs are going to be anecdotal. I think most people rely on media and newspapers. By the time the information gets to that point, the situation is probably 6 months old, certainly months old. I think the best way that people will find out about the turnaround in the market is to talk to professionals at the coalface, because they're going to know about it when it's happening, rather than waiting for it to show up in a newspaper article, which will be perhaps media tends to report movements in prices, and prices actually are quite slow to react. So we're not actually going to find out about the turnaround from price data. It's going to come in other ways.
There's a time lag, isn't there? That's right. So at the coalface is really the way. So even anecdotally, we're starting to see agents calling us more, and they're more amenable to doing pre-auction offers, and they're more proactive about asking us to get through. So I think we're going to do a lot more off-market transactions and pre-auction market transactions with our clients as a definite sign of turnaround. Terry, I want to get to all the questions, and one of the things I just want to do now is just really encourage people to get prepared. You know, we don't know exactly how deep this downturn is going to be, and I really think it's important for people to protect their families and their income. So what can you do practically? And I hope everyone's taking notes here. But what I'd like to recommend you do as a preparation point is start to look at refinancing your current loans. Go to your lender and ask for a better rate. I'd recommend speaking to your mortgage broker and look at helping them to get you the best rates they can get. And if you don't have a mortgage broker, please ask us, and we're very happy to give you a referral. We work with some really top brokers in the industry that do great jobs. And when you're doing a refinance, I'd also recommend trying to get a cash buffer in place. You might be able to get what's called a cash out, and have that as a safety net for you. Because if you are going to be potentially losing your job, make sure you approach your lender now while you've got 3 months of pay slips to prove your income. Now, if you can't do that, if you actually lost your job already and you can't refinance, then just ask your bank for a bank holiday. It doesn't mean you get a free loan, you can't make the payments, you're going to have to pay them down, but it just means you capitalise the interest and you pay later. But at least it improves your cash flow in the medium term. And if you're a small business or a sole contractor, then you can apply to the government for the different benefits that should be coming soon. Or you might want to consider applying for that unsecured loan that the banks are offering as well. But overall, I strongly recommend people keep operating as best you can. Go to the cafes, buy your coffee. Everybody needs to help supporting their local business as best you can. Don't sort of lock down in your home and not spend any money if you can avoid it. But we need that circular flow of income and help each other out. Look after your neighbour, see if they need toilet paper, whatever it is. But I recommend everyone, work together to help contain this virus and do your bit as best you can. Terry, any other thoughts on how our viewers can best prepare themselves for the current situation?
I mean, it's hard to generalise because there's so many different situations out there. Some people will be relatively unaffected. Some may have lost their jobs. But I think the important point to be aware of for people in those sorts of circumstances is that everything that's coming out of government in terms of stimulus packages, both at a federal and a state level and sometimes at a local council level, is designed to help people in those circumstances. The latest package announces a doubling of benefits for people seeking work. That's certainly going to help people in those circumstances, and hopefully will allow people to be able to continue paying the rent or the mortgage. But you did allude to banks perhaps being willing to give people a repayment holiday, deferred mortgage repayments. That's certainly very much in what we're collecting in our day-to-day research information from banks, saying that they will. Lenders have a vested interest in keeping businesses afloat and keeping their mortgage customers healthy. So they have a vested interest in being helpful. So that, yes, they are talking in terms of deferred mortgage payments for up to 6 months, for example. Those sorts of opportunities will be there, and people really do need to be aware that that's possible and to not be afraid to ask. I think that's what the lenders are suggesting. Please come and talk to us if you have a problem. And a combination of that plus the government assistance packages, I'm hoping will get the people most adversely affected through this crisis period.
Yeah. So Terry, let's. I think we're ready for question and answers now. So Terry, I can't see the questions, but you can perhaps just read out the questions and we go through them and just answer them as best we can.
Yeah, look, we have a lot of questions. A number of questions I know, just as I've been scrolling through them as you've been talking, Rich, refer to unemployment. People are worried about the rate of unemployment rising and what impact that will have on property markets. What are your thoughts about that? So,
yeah, property prices are strongly linked to income. It's also linked to the availability of credit and to repay loans. So I think if we get an unemployment rate over 7%, I think that will have a more dramatic impact on the market. If we hit 6%, I think it'll very, very low to mild impact. But obviously people need income to pay for mortgages. But you've got to remember there's very different property markets. Markets that are more what I call the mortgage belt and markets that are very prestige. So I think the markets that will probably be more affected are those that are more mortgage dependent. So again, we just got to watch the unemployment numbers, and we hope that we can get back to business as usual to really contain. And I think exactly what the stimulus package is doing is trying to keep as many people in work as possible so we have income to keep spending in the economy.
Rich, I know we talked about this particular question I'm about to put to you before the event, and I think you may have actually made some inquiries about it. Rob's asking the question, what should landlords do if a tenant advises they can't pay their rent? I think that's a question that's top of mind for a lot of investor owners.
If a tenant can't pay their rent, yeah, very difficult one. So, I mean, again, I think there'll be a lot of tenants out there trying to push back on the landlords and say, hey, help me out. But equally, landlords have got a mortgage to pay as well, and it's going to put stress on them. So I think it's going to be a difficult one. So I think at the end of the day, if you're able to help the tenant out, great. If you can't, then obviously that tenant will have to move out. But it's better to know sooner or later. Terry, I didn't mention to you another product or another opportunity that we've got for investors maybe we could do a webinar. I've just connected with a guy called Prepay, and Property Pay. And what it is, it's a financial opportunity where you can actually get your 52 weeks of payment of your rent up front. So of the 1 year's rent that you should be getting, you can get that right now, and it will cost you about 3 to 4 weeks as a fee. So there is a new product out there that is available. Particularly, it'd be great for landlords that are really struggling with their mortgage payments. They can get all of their rent up front for a fee. It's a bit like factoring or rent factoring, if you like. So I think that'll be another way that sort of landlords can get through this scenario. And if they can get that, they may consider a slight reduction in their rent. But,
the other things that landlords, most landlords would or should have landlord's insurance, and many standard policies have provision to cover for periods where there's no rent coming in. I will come down to what the individual policies that people have, but I mean, a sensible.
I think like Terry Shear has one of the best landlord policies, but I don't think they cover. They cover if the tenant absconds the property, but I don't know if they cover just if the tenant stops paying rent while they're living in there. Again, you've got to check the individual policy and the landlord insurance you've got from your company.
A couple of people have asked this question. Tamara's asking if investors take advantage of the 6 months loan interest deferral. Is it likely to adversely impact their credit rating? A number of people have actually, or ability to refinance in the future. A number of people are asking that question. It's a little bit above my pay grade. Do you have any thoughts on that one, Rich?
Sorry, I just missed the question. Say that again. Just summarise it for me.
A number of people, including Tamara's just asked this question. If you do take advantage of the 6 months deferral of loan repayments that banks appear to be offering, will that impact on your credit rating?
No, well, you're not defaulting on the payment. I don't believe it. You won't affect your credit rating. It just means you're deferring the payment. So it's a mutual agreement between you and the lender. You haven't defaulted on the payment. You've just agreed to new repayment terms. So in my view, it won't affect your credit rating at all.
Okay. Well, a lot of questions have been coming along those lines. Just scrolling through. A few people watching from Perth feeling that Perth is seldom mentioned and tends to get left out of the discussion. I'm certainly, it's a market. Frida, you've asked about Perth. We certainly track Perth, and I think the reality is that Perth was actually right now coming into a period of recovery. All the evidence suggests that vacancy rates down, rents starting to rise, this sales activity picking up, and we're starting to see some areas showing price growth. The current circumstances are going to stall that recovery. I think that's inevitable. The recovery will revive because the underlying economic circumstances that Western Australia was experiencing were improving. There was month by month economic growth happening again, population growth starting to pick up again. So I think
it also depends on what happens with exports, Terry. I mean, if our dollar's very low at 55 cents, if suddenly we get a huge uptick in iron ore and other sorts of resources, Perth's market is obviously heavily invested in the resources sector, so that could help kickstart the market a bit more. But
I think our resources sector are actually going to do extremely well, certainly in the medium term, out of the current situation. China is starting to start its recovery phase from the situation, and I think they're going to be investing big time, and the Australian resources sector is going to benefit from that. So I think Perth is going to take a short, sharp hit. The recovery that was underway will stall, but I think taking a medium to long-term view, it's going to do quite well. It was overdue for an upturn, and I think it's going to be delayed, but it will happen.
Yeah. Yep.
Okay. Look, we're getting all manner of questions about specific locations, and Michelle is asking specifically about Tamworth, and perhaps we could talk about Tamworth in the context of regional markets generally. What are your thoughts, Rich? My feeling is that some of those locations are obviously less affected by the actual virus in terms of the number of cases than the bigger cities. Sydney is the worst affected. And so that's a factor. And perhaps the economies in these places are different. It's more agricultural, for example, less likely to be directly impacted by the whole tourism hospitality thing. What are your thoughts?
Look, I think some of the regional areas again have been badly affected by bushfires, and they've sort of had a double whammy with lack of tourists coming down. You just saw the story on the Lake Conjola down the south coast. So I think some of those areas will really struggle. But yeah, areas that have got a good local or diversified economy, yeah, I'm not sure of the key drivers of Tamworth, but I think yes, that perhaps they may be more resilient. But I think if people are laid off and there's one particular industry that's a major employer in those towns, that will definitely have a ripple effect. So again, it just depends on. I can't really answer the question, Terry, definitively, because it's just going to depend on how those employment drivers are faring in those individual towns.
Okay. A number of questions along the lines of the one I've got in front of me here. Is it a good time to try and get a loan? What do you think, Rich?
Absolutely, great time to get a loan. We've got ultra low interest rates. Banks are keen to lend. I wouldn't be shy about getting a pre-approval. It's a wonderful time to really get yourself set up and in a position to potentially buy. So 100%, I'd go for it.
Another question says, my husband is very nervous and wants me to sell our family home. What's your advice on selling now?
Don't panic. It's not the time to sell the family home. Just ride out the course. As we've been through the whole webinar, it's not the time to panic sell. Stay the course. Talk to your bank about holding on. We'll get through the crisis, but it's not a time to be, selling the family silver just to stay alive. This is a time where you've got to be creative for a period of time. So another suggestion might be you might be able to rent out your home and move in with someone else for a period of time to hold a home. But I wouldn't be, if you're really in a difficult situation, get some financial advice, but I would stay the course.
Yeah, I mean, I absolutely agree 100%. It's not a time for panic selling of real estate. I mean, it just reminds me of past situations like the GFC when similar sentiments were being sprinkled about. People were understandably worried, but I don't think they need to be. Just keep in mind that we're in the midst of a situation which is dramatic, and it's having massive impacts on all of our lives and the way we just go about our daily lives. But it's very short-term in nature. I think we can be sure that it is short-term in nature. Whether it's 2 months, 3 months, or 6 months, it's still short-term in nature, and we will get back to normality.
That's right. Terry, there's a question here on about Airbnb bookings, and I think, at the moment, obviously, a lot of tourism and travel has been badly affected, but I think it'll take a slow recovery. But I do think that those particularly coastal areas will get back up to their long-term recovery rates. And I think Australians are, there's a big campaign about, travel locally. I think a lot of people are put off cruising at the moment because of all the infections, and I think a lot of people are going to choose to holiday at home. So I think Airbnb bookings should recover over time.
Yeah. Okay. Some of the questions, I'm just seeing, there are quite a few asking about Airbnb. I'm just sort of wondering about, areas that have a tourism industry, but it's primarily local tourism. It's not so much dependent on overseas tourists or interstate tourists. Should be relatively unaffected, I would have thought.
I do. I think people want to, once we sort of get the containment going again, people will want to start travelling and enjoying a break with their families, as we always do. We all need breaks, so I think it will start to come out again. I just noticed there's a question about foreclosures and forced sales will rise. Look, I hope not for the sake of those owners that they won't see too many of those, but obviously there will be some people that will be potentially have to actually find the only alternative is to sell. So the question is how to find those opportunities. Well, again, generally they have to go on a public sales campaign. Occasionally they don't, and we get access to some of those through our agent network. That's one of the advantages that we provide as buyers agents, is getting access to off-market properties that may be in distress like that.
Okay.
Making an offer to purchase a property, how lower from the asking price would you feel reasonable at present? Great question. Yeah, really difficult one to answer. Look, I think a lot of properties that were selling in February were selling well above the guide. I believe now they're selling generally within the guide. I don't think generally selling below the guide, the owners would probably end up not taking the offer and just defer this whole selling program. But again, you've got to do an individual analysis of the market to work out what you should be paying for that property long term. So there are, one of the things we do as buyers agents is try to uncover the motivation why that particular owner is selling and try to meet their needs with a price point or a longer or shorter settlement. But yeah, you've got to do your comparable sales analysis to work out what to offer.
Yeah. Ella's asking, is now the time to buy an investment property? We're ready to go, pre-approval and process. Then all this happened. Do we wait? Yeah, I think this question speaks to the nature of real estate, which is a long-term play. I don't think people should be, if they're ready to go and we're planning to do something, the current situation, I think, shouldn't stop them going ahead with what they plan to do, taking a medium to long-term view.
Absolutely. If you're a long-term investor, I think it's just a wonderful opportunity to buy. It doesn't mean you should be in a rush to buy, but I just do think there'll be some really good opportunities to purchase well in the current market. So I wouldn't defer the buying activities, and especially for home buyers too. A lot of people think, oh, I'll just put it all on hold. Well, we're, as I mentioned before, we're getting some incredible results for our clients that are buying homes. And I'm hoping to transact on a couple actually this week for our clients. So we think there's definitely some opportunities out there.
Yeah. Gurpreet asking the question, should we hold on to our savings and see how low the market will go?
Yeah, that's a great question, Terry. We get asked this other one. It's a bit like, as I said, picking the bottom. So let's say you're a home buyer and you decide, I've got pre-approval, I'm ready to go now, and you find the home that really works for you. And you go, you know what, I just don't feel right. It's not the right time. I think the market's going to drop another couple of %. Well, then you wait and everyone else waits. And then when the market starts to turn, 10 other people that had the same thought will all be competing for that one property that's now on the market. So what I say to you is, look, even if the market went down a couple of %, you're going to be holding it for the long term. And you're better off to buy while there's uncertainty than buying when there's mass certainty and mass buyers all trying to compete. We're going to go turn the market's going to turn around again back into a seller's market at some point. This is a short period of time in the cycle where it's a buyer's market. And I would strongly advise buyers to really take the opportunity and look at that today.
Frida asking, if you already had an offer accepted but could still get out based on the conditions of the offer, would you look to do so and wait and see more information?
That's a really hard, I can't answer that because that's an individual property. It depends on, has that person done their analysis on what the property's long-term value is. If you pull out of your contract under a cooling off period, you will lose your 0.25% deposit, and you've got to weigh that up against whether it's worthwhile to lose that property and try and buy it back again at some point, or whether that agent would then sell it to another person pretty much at the same price. So again, it's a very
Shanaz is asking, is Brisbane still a good option given tourism will be worst hit?
Brisbane, great. Well, I think Brisbane, Terry, you've done a lot of webinars about, Brisbane's got a lot of legs and a lot of reasons to invest there. Its median price is half that of Sydney. It's got a lot of really strong, diverse economy, lots of great areas, particularly we're recommending the north parts of Brisbane, much stronger cash flow, stronger rental returns in Brisbane. So a lot of the experts are predicting the next 2-3 years is going to be very good for Brisbane. We think Brisbane's got a lot of ticks for us.
Yeah, again, it speaks to the short-term nature of the situation. When Brisbane was undoubtedly coming at last into a growth phase, it had been talked about for quite a few years, but we're actually seeing the evidence that as we come into 2020, Brisbane is rising, vacancies are now low, rents are rising, sales activity is picking up, and we're now starting to see price growth, particularly the previous oversupply of apartments in the city areas now been largely soaked up and vacancies have dropped a lot. Whatever the impact of the virus crisis is, it will be short term. There will be an impact on tourism to Brisbane, but there's a lot more to the Brisbane economy tourism. And I think the far more important factor is that Brisbane at last was coming to a period of big spending on infrastructure, and that's not going to stop. The big infrastructure projects that are now getting underway aren't going to suddenly stop because of the virus crisis. They will be continuing, and that's the biggest factor driving the Brisbane economy now. And I think that what you should be, I think the approach you should be taking, there may be opportunities to buy well in the short term, and that's what investors and home buyers should be looking to do in Brisbane. Take advantage of the current situation because there's going to be growth going forward.
That's great. All right, Terry, are there any other burning questions, or I think we're almost just over the hour now. Should we wrap up? Is there any other things that we need to answer?
There are a lot of burning questions. There are not surprisingly more questions than we have time to deal with, but we are actually 1 hour and 5 minutes into the broadcast, and we do try to keep these to an hour, particularly as it's a lunchtime broadcast and a lot of people are restricted on how long they can stay with us. So it's a good time for us to wrap up. And for those people who didn't get their questions answered, I would urge you to follow up. You're welcome to contact me at ryder@hotspotting.com.au, and we also have on screen the contact details for Rich Harvey. Rich, I'm sure you would welcome a follow-up from people interested in the market generally.
As I mentioned, Terry, as a special for today, we're offering a 10% off our engagement fee for new buyers that are looking to get into the market, engage with us. So we'd certainly love to help people with their property plans when they're ready.
And we also at Hotspotting do have a special offer for everyone who's registered for today's webinar. But we'll be sending a copy of this broadcast to everyone who's registered, and at that time we will be sending details of the special offers to those people. So anyone who didn't get your questions answered and you would like to get an answer, you're welcome to contact myself or Rich by way of follow-up to today's event. I hope you found it informative and useful. It's certainly been, as I mentioned at the beginning, the biggest event we've staged in the form of a webinar ever at Hotspotting. Just so much interest in this particular topic, not surprising. And I think that Rich, you've covered most of the bases, most of the areas that people would have a question about in terms of the underlying event, the impact on the economy, how long is it going to last, what's the impact going to be on real estate. And I think if there's one central message that we would like people to take away from today's event is that please keep in mind that this event is short-term in nature and that the long-term prospects for real estate continue to be very solid and strong. Keep that in mind when you make your decisions going forward. That's it for now. Thank you, Rich Harvey, for your input. A great presentation, great information, and thank you everyone out there who's watched and listened and participated, and thanks for your questions. This is Terry Ryder from hotspotting.com.au signing off. Let's do it again soon.
Thank you very much, Terry. Thanks everyone for watching. Thanks again.